All right, welcome back to another episode of Asset Coach and Tax Strategist. And so today, what I thought I'd do was go back, take a few steps back, and let's look at some of the basics. What do I mean by the basics? As business owners, a lot of times we just kind of get thrown into business, and for whatever reason, if you're running a medical practice or a doctor's office, and you went and got your medical license, you did your residency, right? You did all the things you needed to do, and all of a sudden you are in practice. You're running a business, and not necessarily taking classes on looking and learning about the financials and how to read the financials and what to do about taxes and what should I do with my money and all these things that come to you after a while. When you open up a business, it's, oh my goodness, I got rent, right? I got utilities. How do I negotiate my rent? How do I negotiate my utilities? I got insurances that I have to pay for. Oh, I got to hire people because I can't do everything on my own. Software systems. Oh my goodness, I need equipment for the software to be on. Do I finance? Do I buy it? What do I do? Vendors, contracts. So if you have contracts with organizations, like on the insurance agency side, you have contracts with insurance companies. If on the medical practice, yeah, reimbursements and what's that look like? And so there's just all these things before you even open up the doors, just before you could even, how do I get patients? How do I get clients, right? Oh my goodness, I got marketing. Can I market it? What kind of specialty, what's my business? What's my product? What's my service? Can I do it on social media? Do I need to go knocking on doors and build relationships and network with other doctors or other business owners? Whew, wow. It's a lot. And we do it. We do it. As crazy as that just sounded, we do it. Not because we're crazy, because we're excited. It's ours. It's what we get to do, and and for all the reasons that we decided to do it, whether it was freedom, whether it was I want to do it better than the guy I worked for, or you know what, I'm taking over the family legacy, and that's a lot of responsibility, or you know what, darn it, I just don't want anyone to tell me what to do. And being a business owner, you don't get away from that. But whatever reason, these are all things. And then as we're starting to run our business, then we start looking at the checking account and we're like, okay, I got to get some revenue in because I got to pay these bills. And so you may have gotten some funding from family, friends, banks, however, right? Whatever you use to get the initial funding to help you take this next step into this journey. And so you're sitting there and you just do it. And really, the main financial statement that a lot of business owners start off with is their checking account. Do I have money? What's outstanding, right? So I got to get a bookkeeper or an accountant or someone to track this kind of stuff for me. Because there's too much. It piles up. It ends up being a lot. And so anyways, and I'm not saying all that to scare you. Hopefully it didn't. You're like, holy crap, I did do that, right? But we just do it. That's the crazy thing. We just do it. And then all of a sudden we're here. And now we're at a point where we did it, right? Not that we're gonna stop and rest on our laurels, but we got it started. We're up and running. We've beat the statistics. We're beyond 3 years in business or whatever the statistics are for your industry. And we're making it. And oh my goodness, I've got profit. And oh, wow. I've got profit, but now I got taxes. That's a lot of taxes. Where'd all those come from? Right? And I'm working my tail off. And we have some clients in California, where I'm originally from, and based on their success, they're paying 50+% in taxes with state and federal and Obamacare. The net operating income 3.8%. Capital gains is at 20% if they are selling assets. And whoo-wee, what do I do? And so I don't say all that to just, again, to create fear or anxiety. I say that congratulations, good for you, man. If you're worried about that, you've surpassed that first hurdle, so to speak, that speed bump that just looked like more than a speed bump, looked like a mountain. And will I ever attain it? And now, once we got to the top of the mountain, what do we see over the ridge? Oh, more mountains, right? We're not at our destination. It just keeps like, oh my goodness, I gotta keep going. And that's life. That's the journey of life, right? That's the journey of a business owner. And so now I gotta look at financial statements. Now I gotta look at my tax return. Now I'm like, oh my goodness, there's gotta be something I can do. And so what we're going to try to do here in the next few videos in the series of our channel and content is let's go through some of the basics. Now, I'm going to go through some financial statements. We're going to talk about financial statements in this video, okay? I know, exciting, right? I can't wait. Bob, stop yapping and just show us the numbers, right? Nobody wants to talk about this. Taxes, finances, insurance. No one wants to talk this stuff. But we need to understand it because this is what's ruling our life right now. If you understand how the rules are designed and how the game is played, you get to play the game rather than be played by the game. Big difference. Same letters, same words, organized differently in a sentence makes a world of difference. And so we want to make sure we understand. Now, I'm going to go through and generalize what financial statements are. Okay, so I'm going to share my screen. We'll walk through what Investopedia says, public website, you can go and find this stuff. If you've watched me long enough, you'll know I'm just sharing stuff that's already out there in the ether and just telling you where to go. Okay, now I watch a ton of YouTube videos on other guys that are way smarter than I am. So if I seem smart, thank you so much. It's only because I'm regurgitating what all these really smart people are saying and I'm retaining a portion of it. No different. That's what's happening here, right? You're retaining a portion of it. So what I'm going to do is go through an overview of what the key financial statements are. And then what I'm going to do is I'm going to go through a couple of examples. Now, not examples of as I'm a CFO or I'm a bank and I'm going to lend you money. No, I'm going to go through it as how I look at a financial statement of a client for planning purposes because they come to us and say, oh my goodness, Bob, I feel like I'm paying a ton of taxes. I don't know what to do. I'm working my tail off. What do I do? So I'm going to show you two examples. Okay. And so let's dive into here really quickly and just do that. Okay. So well, I'm not going to spend a ton of time on all this information, but this information is important. Again, it's by Investopedia. Here's the people who wrote it and all that kind of stuff. Bottom line, what are financial statements? They basically give us an overall financial condition and profitability of a business. Plain and simple. That's what we're looking for. Statements are usually required by what's called General Accepted Accounting Principles, or GAAP. Okay, this is normal, and these are a balance sheet, an income statement, also known as a profit and loss statement, P&L, and then a statement of cash flows. Those are the three main ones. Now, we have a couple customized that we do to manage and understand flow of cash in parts of a month. So some of the things that we'll do is we'll take a month, we'll break it in half. So the 1st to the 14th, what revenue, what expenses do you have? 15th to the end of the month, what revenue, what expenses do you have? And the reason why we do that is so we can plan and we can estimate on how we're going to do our planning, right? But because also with us, where it's not just about how do we save money on taxes and stuff, but our company, when our members come to us, what they're coming to us for is helping them to structure and organize their business for an eventual exit, meaning a sale. Now, that may be a year from now, that may be 10 years from now. It does not matter. But you should be running your business with the mindset of when you're at this point that we're talking about, oh my goodness, I'm paying a lot in taxes. You should be of the mindset now at some point I'm exiting, whether I want to or not. So I want to build my business on an annual basis to be prepared to get the biggest bang and payment back, because this is your blood, sweat, and tears. You spend more time in your business than you do with your family and loved ones and friends. So it's very important. All right, so we'll go through this. The balance sheet talks about assets, liabilities, and what's something called shareholder equity. Okay, so we'll look at that a little bit. The income statement, or the P&L, okay, focuses on revenue and expenses in a particular period. Okay, and so what that looks like, and what net income looks like, and then the cash flow statement just shows how the cash cash to pay debt obligations, really the operating expenses and investments. Okay. So how's the cash flowing? Now, we don't use so much of the cash flow statement in our planning. But it is an important process and vital. There's a couple pieces of information that I like to see in there. All right, so that's the financial statements. Now we can go through more detail about a balance sheet. Don't worry about that. Once you become a member of ours, we actually have this as part of our starter kit course, and we go through details of this stuff and all this and liability, shareholder equity. We go through it. They show some examples, so we have examples on ExxonMobil. The problem with these examples is that that's public information. Right. So you're looking at a public corporation. Well, on a public website, they need to have public information, right? They're not going to go to some private owner like, well, I'm going to show you some redacted financial statements and be able to have access to that. They don't. So a public corporation has different things to view than a private. Okay. And so anyways, we can go through all this stuff if you want, but I'm going to save you. I'm just going to dive right into it. I don't want this to be, one thing we don't want this to be is a 2-hour long episode. No, thank you, Bob. I'll lose you, right? I may have already lost you. You're already not listening because you already left. Just kidding. So this is important. But all this is information that's in there. I'm going to go ahead and we're going to have this in the description, but also we'll have a link to how to get to our membership starter course in the link as well. You'll have access to more, basically a course on this. Okay, so let's look at our first example. We're going to look at a P&L first, the profit and loss, which is the income statement. And so this one's based on accrued accounting. So accrual accounting or cash accounting. We won't go through the difference right now. But as you can see in this scenario, we've got their total income. Okay, so they're a healthy business. Then they have cost of goods sold. What's the cost to generate this income? Okay. And so we got to look at all this, and all this stuff subtracts from this, and then it gives us what's called our gross profit. Okay. Our gross profit. Now the reason why we have gross profit and all this cost of goods doesn't go into normal expenses, because what we're doing is, as a business, right, we're providing a product and or a service. And in that product and or service, there's a cost to that product. And so that you can't have revenue, pure gross profit revenue, without having to spend money on that cost. Okay, so that's why it's up here, and then we get our gross profit. Okay, now not all medical practices in this has all this stuff. Okay, every financial statement is different, but the structure is pretty much the same. What information goes into it is different. Okay, now let's go into expenses. So now these expenses are normal, right? Advertising, auto expense, if there's bad debt, we have servicing, bank service charges, right? All this stuff is normal, charitable, good for you, computers, conference expenses, payroll, right? All that fun stuff, general liability insurance, you have those. And so let's go to the next. So, and you can get as detailed as you want. So we have medical supplies. You can actually go to medical supplies from a particular vendor if you want to get as detailed as you want. And so whatever detail you want is what the bookkeepers will do. Okay, whatever you want to see is what they'll see. They'll share with you. Okay, so the cost of recruiting, you get it, state taxes, payroll, right? We got all of this done. And then we get to the very, very bottom, net income, boom. Okay, profit. Okay, now if you're set up in a pass-through entity, time out, what's a pass-through entity? Well, great question. We have a Tax Return Academy course that also is in our starter membership kit that we provide. But an entity is, like in this situation, they're an S corporation, so it's a pass-through. So you have an S corp, and what that means is that at the end of the year, 12/31, this profit passes through to the partners and owners based on their percentage of ownership as a K1. Okay. So what's that mean? It means it's going to be taxable income. Okay. So when we come in, this is what we look at and say, oh, okay, Mr. or Mrs. Client, here's your profit. Now, what we need to do is look at some planning strategies. And so we start building our planning strategies off of that. Okay. Because this hasn't passed through to the owner yet, only at the end of the year as a K1. So we have an entire year to do planning. And based on the planning, we can affect estimated tax statements, payments, and all that kind of stuff. Okay, now let's look at a balance sheet. And the balance sheet is going to give us what the assets we have. Okay, so what are assets? Well, we have current assets, so checking account. So sitting in checking account, they've got $500,000. They have some accounts receivable. I love seeing accounts receivable low. This is important. That means their collections are good, or they're a cash business. Okay. They're not waiting for reimbursements from insurance companies or vendors or anything like that. Now they do carry some inventory. So remember the cost of goods sold. So they have a product that they're selling, not just a service. Okay. So there's a cost to that. So they have inventory. Now our question is, how quick do we get rid of this inventory? Okay. Now inventory usually is a 12-month, but if we can get this off the shelf quicker, it gets to be what? Cash in the account, right? Revenue, profit. Okay. So this becomes part of our process of diving in a little bit more into our client's situation. So you got some fixed assets, and then you have your total assets. So your 2.2 million, and then now you have your liabilities. Okay. And liabilities would be accounts payable. What do we owe vendors? Any type of credit cards or loans or lines of credit we have, any auto loans. So remember up here, so like up here, we had a car. Well, we have an auto loan for that car. Okay. And let's see here. We have other loans, blah, blah, blah. Those are other current liabilities. And we have our total liabilities. And then we have whatever our total liabilities are. So now what we got to do is subtract that from our assets. And that's where equity comes into. So member draw has the member owners taken money out. Is there still equity tied up in here as value, cost basis of value? And so notice this number matches this number. There has to be a balancing. Okay. So whatever your total assets are, minus your total liabilities is going to be, the rest is going to be an owner's equity. Okay. And so that's the first one. Awesome. Great. Now, how do we look at this? Well, for us is that if we're looking at over here, a profit and loss and profit of 3.3 million, and we're going to put strategies in place. We need to know what cash they have on hand. And so we need to understand this part. Okay. So when we understand this part, it's like, okay, is this money that's staying in the bank, or is this money that's going out the door? Okay. That's important, because part of that 3.3 profit, right, is going into other assets such as inventory. So we have this cash. How are we going to use this cash for planning? Okay. What we don't want to do is tie up capital to allow the business owner not to make decisions. And our sample 2 client will see that and what that looks like. All right. So that's where we're at. So not bad, pretty easy, right? That's client 1. Now we're not going into strategies or anything. Now look at our financial statement for our profit and loss is different. So here was the first one, right? This is what it looked like, the report. And then the other one has a different look to it. Structure is the same though, right? We have our total income, 1.7 million. Notice gross profit right away. It's a service business. There's no cost of goods, no cost of goods. So there's no cost to create a gross, to take the cost of goods out of revenue to create a gross profit. All right. So then we got, of course, our advertising and marketing. Notice that advertising and marketing is broken down a little bit more. So we got promotional, we got meetings and events, social media, website. So this particular client wanted to see it broken down a little bit more. Great. Auto expenses. Awesome. Bad debts. Okay. Now we go into other things such as gifts, business insurance, other computer softwares. So that got broken down. And then other supplies. And then we go on into accounting. And so when you want to know, hey, how much am I spending on well, you're spending right now, last year, this particular member spent $9,000, almost $10,000 on accounting and bookkeeping. Okay. And so what do you get from that? That's the question, right? What am I getting from that? Payroll. So here's the big one. So this is the big one for this client. So let me go down to the bottom. And so we got all our expenses, and here we get to net income. Not a lot of profit. That's a positive and a negative. What I mean by that is it's a negative if there wasn't planning of any other profit in the planning that was done tied up capital. What do I mean by that? All right, here we go. Right here. Where'd it go? Where'd it go? Where'd you go? Oh, here it is. Sorry. Okay, so right here, qualified retirement plans. So this particular client tied up $378,000 into retirement plans. Okay. Now, how it's structured, all that kind of stuff, we're not going to go into that today. All right. But what the client needed was capital. And so he also wanted to save money on taxes. So based on various strategies that are available, he was, hey, I want to save money on taxes. What the advisor, the client, or the professional that the client was working with didn't understand was that this is a business that's still growing. And so he's going to need access to capital in January and February for next year's expenses to get revenue flowing. So all of a sudden, this client tied up $378,000. Yeah, it came out of profit, but now look what he has. He has no capital. No capital. So let's go to the balance sheet and take a look at that. Here, this is what the balance sheet shows us. I got no cash. So now if you go into the next year with no cash, what do? You got to borrow. You got to find capital. Okay. So utilizing retirement plans as a tax strategy is not a good idea if you need access to capital. You set up retirement plans because you want to save for your retirement, and you have excess profit in capital to where you have money to go into capital if you're running your business, and then you also have extra to put in your retirement account for later on. The client's mode and focus was save money on taxes. He did that, but by doing that in a qualified plan, a retirement plan, he tied up capital. He doesn't have access to it, not until he's 59 and a half. Ooh. The way they structured this is that now they've got to do this on multiple years. Ugh. So for us, it's cart before the horse. You got to understand the business and what your business and what you need is capital. That's what these financial statements will tell us. Okay. Now, in this particular client situation, what I do like to see is that he has 200,000 accounts receivable. So he should be getting 200,000. But when? When can he collect this? Is he going to collect this in January and February to help with capital? I don't know. So does he need to get access to credit lines and capital to pay for this? Or wait for this, I should say. Okay, that's the big question. This is where the cash flow statement, a statement of cash flows, can help us out. And because in the balance sheet, what we don't see over here is just that, is accounts receivable. So let's go to the P&L. Let's look for accounts receivable over here. What do we not see? Accounts receivable. Okay, so what we need to know is to understand the statements of where our money is at, where's our capital going to be at. So these are examples. So this is important, but now all of this affects your tax return at the end of the year when you do taxes. So it's all intertwined. So if you have a bookkeeper, an accountant, and you just have somebody who just files your taxes and it's somebody different, or it could be the same person, but they're not thinking about tax planning, but they're also not thinking about needing access to capital. So this accountant and CPA would say, oh yeah, save money on taxes. That's a great idea. Go ahead and use a qualified plan. Oh, those are great. Those are great to save money on taxes. But what's the next step? Access to capital. Okay. So that's very, very important. You're a business owner and you need to run your business, and the only way you can run your business is with cash flow, and which is capital. So that's very, very important. So hopefully this was helpful. I know it's a bit nerdy, but this is so important. This is the foundation of everything. Now we could dive into more weeds and if and then and when and how and blah, 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 blah. We're not going to do that. You're welcome. But this is important as an overview to have a good understanding of this. So hey, subscribe, give us a thumbs up. This is as a business owner, you should giving us a thumbs up. You should be subscribing. As a business owner, you should be sending our episode to other business owners and say, hey, have you checked this out? This guy goes over financial statements. Have you ever gone, do you know what the heck you're looking at? I don't. Send this to them. Okay, help them out, help each other out. We need each other. Add your comments below if there's more you'd like to dive into weeds, and enough comments say, hey, dive into more weeds. We'll dive into more weeds. Or if there's other things that you want to hear or listen to, or if you want to just say, Bob, this was freaking boring. Please don't ever do this again. Awesome. Put that in the comments as well. So thanks so much for being a subscribers. Thanks so much for just spending the time, investing the time in you, not in time with me. My time was recording this. You're investing time in you. You're building here, right? You're building this vault for you to be a better and better business owner, and no matter where you're at in your journey. So thanks so much. Have a blessed day.